Hi, everyone. Thanks for coming to the Seattle Angel Conference workshop series. Today, we're going to talk about due diligence with Kurt Bilafer. We're going to engage in the process of exploring startups in detail now, because what we're trying to do is to get people ready for the workshop series or the investor process that starts on September 3rd. So all of the companies that apply for this round need to apply before September 3rd. And I'll post into the chat window. There's a little chat button down there, the link to register. Our goal is to help new companies become more investable and to help new investors learn how to write their first check. So Kurt, if you would turn on your video and your camera, you should pop onto stage with me. There we go. So Kurt Bilafer was our LLC manager for SAC 17, the last round. And as an LLC manager, he ended up playing the role of lead investor for the syndicate that was formed. So we have 40 investors, 5,500 apiece, form a $200,000 fund. While Kurt was the LLC lead, Eric Watson was the assistant, which makes Eric the LLC lead for this round. And that's how we sort of train people or give people the experience of doing angel investment organizing, right? Being the lead investor on a deal. But Kurt is kind of special. He's invested a lot more than most of our investors have done, has a lot more engagement in the Silicon Valley ecosystem as well. So he's seen dozens of companies that people in Seattle have never seen. And so I asked him if he would talk a little bit about due diligence and such. So you want to try to put on your share screen so we can prove that that works, and then I'll step off stage.
Can you see that okay?
I can. It works really well. So I'm going to step off stage. Thanks so much for doing this, Kurt.
You got it. You got it. Well, thanks, everybody. I think if most of you have done this before, you know you have to ask questions in chat. So I am going to try to multitask and pay attention to what's in chat while I do this. These are not the most effective way to make the presentation and make it interactive. But so just a little bit about me. As John mentioned, I was a SAC 17 fund manager. I was actually in SAC 16. So I've run through a number of due diligence cycles with the Seattle Angel Conference. There's a bunch of alumni and active participants that are currently on this event, and they always help out, right? So by way of background, I am an LP in a number of venture funds. I run an angel syndicate. I invest via other syndicates. I think I've done like 108 or 112 investments. Moved up to Seattle 3 years ago, came up here with Amazon, left Amazon, and now work for a SaaS company that I actually helped fund. So exciting times. So I'm going to take you through kind of my thoughts on due diligence. This really is intended to be interactive, so hopefully John jumps back in and peppers me with questions. But essentially, you know, I've read a number of books on sort of best practices and approaches to this, and there's a lot of great content out there. So I'd encourage you guys all to sort of do your own homework on that. But basically, I look at the due diligence process, sort of the more sophisticated requirements really grow as the company grows and as the round size grow and as you move from sort of pre-seed to Series A. So in pre-seed, the investors are typically like families and friends, angels and syndicates. So this could be angel syndicates that are investing. And the focus is really on the team and the big idea, which some people call the TAM or the total addressable market. And here...
So a little bit of help for people.
Yes, sir.
If people are looking at this slide and saying, oh my goodness, I can't read the slide. If you click on the slide, it'll get bigger and you can expand it so it's the whole screen. And on some people, you can click on Kurt and right click on Kurt and get it to be picture inside a picture. And so then his little face will show up in the corner. So if you make that screen bigger, you'll be able to read it a little bit. And don't worry, I will either chat in the chat or pop on stage to ask all sorts of questions.
Awesome. Thanks. Okay. So, as you kind of go from left to right, so starting with pre-seed, this oftentimes isn't the first money in, but that's just called the first structured round. The focus is really on the team and the total addressable market. So how big is the idea? I have some subsequent slides, but ideally you want something that's like 5 billion or more. So the bigger the opportunity, then obviously the bigger payout, but the less market share the company actually has to own in order to see a significant return on investment. And so from a due diligence process, the area that I really focus on is the corporate structure, making sure it's like vanilla, which means that there's no surprises in terms of the device they're looking to raise, right? So no weird convertible notes or safes or anything like that with unusual clauses, and that the cap table is super clean. So that's kind of how I look at pre-seed. Then when I go to seed, it's all those same requirements, plus really what I'm focusing on is what's called product market fit. So I want to make sure that the company's solution can actually be deployed, sold repeatedly at the desired price point. So for me, product market fit, or PMF, and make sure that there's really a clear understanding of unit economics. So unit economics are everything like CAC, which is customer acquisition cost. Sorry, I'm going to use a bunch of acronyms. Customer acquisition cost, what's my churn, customer retention, the customer lifetime value, those sort of things, because that's what I'm building the economic model on. So John's asked me a question of what is a cap table. So a cap table is a capital table, and that basically lists out everybody that owns part of the company, the shares that they own, and therefore the implied valuation of that. And part of a clean cap table is there shouldn't really be anybody on the cap table that currently isn't providing value to the company. So oftentimes over the sort of, I guess, life of an early stage startup, there might be a co-founder that decides to leave. There might be a key hire that's now departed, and you don't really want them on the cap table. You don't want them profiting from ongoing business. So the goal should be to buy them out or cancel their shares or whatever it is that's the right thing to do. But that cleans up the cap table. And the sooner you do that, the easier it is as you move down the road. Another question is, what is an ICP? So an ICP is an ideal customer profile. So oftentimes when we start companies, we say, I'm going to make this widget. Let's just say it's a pair of shoes. And these shoes, we don't get specific. We just say we're going to make these shoes at half the cost that Nike makes them, and we're going to sell millions of pairs. But we don't really pick out the specific individual and all of the criteria associated with that individual so that I can't target them. So having that ideal customer profile or ICP is really important because I can test that thesis and I can refine it over time. And that's what allows me to start to scale. So if I'm selling the product to the right ICP, in theory, I'm going to see tremendous growth in a relatively short period of time. ASP is another acronym I have on the slide, which stands for average sales price. And ASP is basically the average price each one of your customers is paying for that offering. And so, when you're at this stage and you're doing due diligence, there's a number of things that need to happen. And so first of all is, does the company have customers? Are the customers real? And that really starts with you calling those customers and reviewing their agreements, but also have they paid what the company now wants to charge? So there's many deals that I've seen where they want to sell a solution for $5,000. They say they have 20 customers, and for $50,000, they have many customers. You start digging into these customers, you find out they've only paid $5,000. So somehow magically the average sales price is going to 10x. And so that obviously raises a red flag for me. Now, there's things you can do to incrementally raise your average selling price, but to 10x it is very, very difficult. So that's kind of average sales price. And then I think the other big thing is, we want to make sure that they've demonstrated that there's a defensible moat. So this is the other thing, is that when I'm in the seed stage, I need to be able to say I've built IP, or I've become so sticky in these companies that the ability for me to be ripped out and replaced is significantly reduced. So the more sort of friction, if you will, or stickiness that I can build with reducing customer churn and make it more difficult for, competitors to enter the market, the better. And so that's really what I'm focusing on with seed. And then from a Series A standpoint, what you see here is these are seed and early stage venture funds. Now, the reason why I call out who's really investing is you have to put yourself, just like you do when you're selling, in the mindset of your customer. So when you're selling to angels and to syndicates, and you're basically, that's what you're doing, is you're selling the concept and idea of your business and why they should invest in you versus somebody else. And the reality is, any active angel is seeing dozens and dozens of deals on a monthly basis. And if you participate in syndicates, that could be hundreds of deals. So you need to have something that sort of stands out. So understanding what their mindset is and how they invest is super important. And so in that Series A, when you're talking to seed and early stage venture funds, it's really all about you demonstrating historic execution and the ability to demonstrate that you're going to effectively scale the business. And this really comes down to like having a plan for your capital stack. So looking at current investments and where you think you're going to get investments and what you think the valuation of your company is going to be at investments. Because when you're dealing with these early stage funds, they're all looking for high multiple returns, right? They're all looking for 10x returns and those sort of things. And so you need to be able to have a roadmap. And part of that is by you showing that you can plan, you're showing that you can lead and that you have control over the business. The other things that they're certainly looking for are productivity, new markets, like what's the next bowling pin, where are you going to go next? And that path to the next round. So understanding, a lot of times when people raise Series A, it could be just depending on where you start in the process. Let's just say you're raising your Series A when you get to $1 million in annual reoccurring revenue or ARR. Your Series B might be when you get to 10 million. So you need to be able to show them how long it's going to take you to get there, what's your cash burn going to be like, and that you have a plan and you understand what that plan looks like. So I'm going to pause here to go through a bunch of the questions that have come in. Okay, so one of the questions is, are there any texts or books on due diligence that I'd recommend? There are a lot of them. So the one place to look is the Seattle Angel Conference has a YouTube channel, and there's a couple recordings there that list out specific due diligence processes. From an investor standpoint, I think part of it is understanding what types of companies you're going to invest in. In other words, what stages. And the reality is, as an individual angel, you can do your own due diligence, but you should really try to, partner with the lead, right? So someone who's going to write the biggest check that's really going to lead the round, because they're going to do the same as well as additional due diligence. And so it always benefits to sort of work with them and assist them in the process. I'll make sure John follows up with a couple books that you can read, but there's some great, Medium blog posts that are out there that talk about some of the things to look at. And Seattle Angel Conference itself has put together a best practice for doing due diligence. And as part of the evaluation process, whether you're on the company side or on the LP side, you get to live that amazing and so exciting process. That's sarcasm since no one can respond. Okay, so there's a question from Wadad. How are you? And so the question is, what's the problem with a co-founder that left the company profiting from it? Is a concern that they might want to influence decisions. So there's always a concern that when people are on the cap table, if they're not involved in the business, the things that they can or cannot do. So oftentimes they might have information rights and those sort of things. And if they aren't actively aligned with the ongoing direction of the business, that can certainly create problems for the founders. And it just depends on what percentage of ownership they may or may not have. I think the other big thing is, equity gets tight. And so if someone has, let's just say 5% ownership at the pre-seed, now's the time to buy them out rather than them maintaining a high proportion as the valuation for the business, hopefully gets into the hundreds of millions of dollars, right? So I think part of it is, and this is the same way with advisors and everybody else, is when the value to the company ends is really when you need to end their ownership, and whether it's investing or anything else, and try to buy those shares out when and if possible. Because otherwise what ends up happening is as you continue to go through the fundraising process, your cap table can get to be pages and pages long, which means when you do a raise, typically everybody on the cap table is going to have to sign documentation every time you do something and create an employee option pool. Oftentimes all of those being informed and tracking all of that information becomes just a huge nightmare, right? It's just another burden for another signature. So what's the incentive for the co-founders who have contributed significantly before the round? Well, I guess there's a couple things. So one is, in the early days, the valuation is very, very subjective. The investors, even though angels consider themselves professional investors, the reality is most of these things are being done in the form of safe notes or convertible notes. You're not really necessarily doing a priced round at the pre-seed level, though some people do. And so I think part of it is co-founders' ability to get in early, get a larger piece at a much lower valuation, which is why it's always exciting for companies to join early stage ventures. Is you may not get a full percentage, you might get a 0.5% or whatever it might be. But in theory, if you stick with them for a couple of years, the valuation of that stock increases significantly. So there's always motivation for that. I mean, that's the financial motivation. I think the additional motivation for working in a startup is the ability to build something new and exciting, right? Whether it disrupts or replaces or augments something else that's out there. I built 3 startups that had 2 exits, and for whatever reason, I just keep going back to startups, whether they're my own or somebody else's, because I think it's hard to find something else that's as satisfying as building a repeatable, scalable business model. Okay, Alex asked a question: would AI-assisted software development be considered a defensible moat? I guess the devil's in the details. So what's interesting is oftentimes the things that are defensible are not protected. So it's not IP or trademarkable or anything else. In fact, some of the advice from early founders is to do things that are not scalable and repeatable. I think Amazon's a great example of that, right? If you read the early days of Amazon, so much of what they did was not profitable. It really wasn't repeatable or scalable, but no mature business was going to do that because they were losing money. And so I think the way to think about what a defensible moat is, when you look at your competitive set, and that's something you should always be looking at, is are they likely to do this? Can they do this? And what does it do to their business? The challenge with publicly traded companies, if that becomes your competition, is they can't necessarily afford to lose money because their shareholders, and first of all, they're going to have to disclose it, but their shareholders may not have an appetite for that. So there's lots of ways to build a defensible moat. Technology is not always that way. Okay, next question is, are you looking at product market fit at the seed stage? Wouldn't that be chicken and egg problem to solve? So yes, in multi-sided marketplaces, there's this whole notion of chicken and egg, which is basically you need to build the demand side and you need to build the supply side. So basically you're building 2 companies, something that satisfies for the demand side element of the marketplace and something that satisfies for the supply side. I think the challenge that you have is, particularly in marketplaces, is there are specific investors that have an appetite to invest in those marketplaces. For product market fit, when specific for the marketplace model, the way I look at it is you either have to have a demand side product that's built and satisfied and lots of people on it, or the supply side. Now, typically what needs to happen is you need to build a supply side so people actually come and buy. And so that's where most companies focus. So they try to build a product that the suppliers of whatever the marketplace is going to run on, that they create something that's sticky and unique and that basically these companies can't do without. So that's how I look at product market fit for marketplaces. Okay, so another question is if I have examples of a defensible moat. So a lot of the stuff that I've seen for defensible moat, I guess, is sort of things that other companies are unwilling to do. And it isn't always about losing money. Sometimes it's SaaS companies starting off really as agencies. In other words, they sell a platform fee but do a lot of manual processes that other SaaS companies are unwilling to do. And by doing that, they woo a tremendous amount of customers over. So, it could be like a call center technology company that has core underlying technology, but maybe they help write the call scripts and they help do a bunch of things that are manual that their end customers don't have expertise in. And as a result of that, they're able to onboard lots of customers, quickly ramped up their platform fees, and then over time start to just educate the market on how to do that. Now they have 50 to 100 customers that are using their core product. They've educated people and basically commoditized what used to be an agency feature. But because now they're so entrenched and they have these 50 to 100 customers and they've learned specifically what all the pain points are, those sort of things become defensible moats. There's a misnomer, I think, about the defensible moat, and that is that, it isn't always a cost thing. So someone else could do it. The question is, would they choose to do it? And I think, in full disclosure, I'm ex-Amazonian, and that's one of the things that we look at is, are these processes valuable enough to a customer that they wouldn't leave? So Alexa is a great example, right? So Tom, who runs the Alexa team, his whole thing was, what if I made Alexa so valuable that people were willing to pay for it? Now, wouldn't necessarily ever charge them for it, but if I could do that, then no one would ever leave. And if no one ever leaves, that becomes a big defensible moat for me. And so the Alexa team started to invest in a whole bunch of things that didn't necessarily make money for the company, but made life easier for the customer. And so that's kind of how I think about the defensible moat is, if the lunatic fringe, the early adopters of your technology would never leave you, it becomes defensible. Okay, let's see. Okay, John's posted a couple of exciting things. Okay. To John's point, it's not just SAC that doesn't like safe notes. The reality is, as John mentioned, I'm not originally from up here, right? So I spent 20 years in the Valley, the San Francisco Bay Area. And because of Y Combinator, safes are everywhere, but in the Pacific Northwest, they are not welcomed. It's kind of like, I guess maybe like Sasquatch. If someone saw it, I'm not sure how they respond, but based on what I've seen and heard, it's not a favorable response. Okay. And Alex makes a good point about product market fit. So yes, product market fit always evolves, and it primarily always evolves because your customers' needs are always evolving and customers are always demanding more. Okay, so I'm going to move to my next slide. So this one is specifically for angels. So I'm not sure if you guys have heard of a guy named Jason Calacanis, and I have his book somewhere, but he wrote a book called Angels. And he is not a Valley guy. He's a blue collar, East Coast, Brooklyn, I think is where he grew up. In his fund, I sit on a board with Jason. I invest via his syndicate. I'm a big fan. I guess I'm a Calacanis. I have a Calacanis crush because I think a lot of what he does is make deals accessible for everybody. But he's influenced a lot of my early angel thinking, and some of the things I think every investor needs to have is a clear investment thesis. And so for me, I've now been investing for, I guess, maybe 7 years. The first year or so, I just spent imaginary money. I kept a journal of the deals I would invest in and why, and the deals I passed on and why. And I kind of watched to see which ones were getting round write-ups and started to turn my own sort of blind spots, but also the areas where I had passion and conviction to invest. And so that investment thesis is super important, but as much as figuring out where you want to invest, figuring out where you don't want to invest is equally as important. And I'll come back to that in a minute. But the other thing is, entrepreneurs have a limited amount of time, right? They don't want to spend all their time fundraising. They want to spend all their time building a business and satisfying their customer requirements. And so you don't be an angel. Sometimes I call them broke angels, but don't be a check. So if you can't write a check for whatever reason, you're over allocated, you double down on investment, whatever it is, just be really, really transparent with the entrepreneurs. It hurts your brand reputation, but you also don't want them sort of spinning their wheels and chasing you around if you don't have to actually have the ability to write a check. The other big thing is you have the ability to say no and to say no quickly. So there's a lot of angels that I work with that just want to be nice, and not that I want to be a prick. Though I did grow up in the East Coast and spent a lot of time in Manhattan, and so certainly have that skill. I think entrepreneurs need to understand if you're going to pass on a deal or not. And so the ability to say no and to say no quickly and provide them reasons why. And you can be polite about it, and breaking up is hard to do, but they invest a significant amount of their time, and they benefit greatly if they know that you're not interested. And just if they can take a reason away from that interaction of why you're not going to invest, that's super important. The other thing is learning to say that not yet. So oftentimes I hear angels say, I just need this one more document. I just need this one more document. But in life, we typically know, it's a yes. If it's a yes, it's a yes. If it's not a yes, it typically means it's a no. If it's a not yet and you just need another year or some more evidence, letting the entrepreneur know that is absolutely critical. Again, right, this is all about preserving cycles. Once you put angel on your LinkedIn profile, you will find that you get a ton of people reaching out to you. So you need to have this filter to say no, or when things are nearly qualified, say not yet, and be clear about what items you need. And the last thing, and this one's really important to me, is a passion for being of service. So most angels don't become angels because they just want to make a tremendous sum of money. It's because they want to give back. And so, for me, that was a big thing, is having been a founder and living through a lot of cycles. I really just wanted to sort of be an ally for companies. And so, I think I sit on 5 or 6 boards now. I advise a bunch of companies, and I do that because I like to, because it's a passion for me. And so I think that's really, really important, is once you make an investment, you don't walk away from it, right? You become an evangelist. You become oftentimes a shoulder to cry on, or someone that the founder can network with. And so that's super important. And then this is one of my favorite quotes from Mark Cuban, which is, you only have to be right once. So I think this is the other big thing that we all kind of freak out about when we're trying to manage this portfolio, and we're trying to hedge, and we're trying to do this, and we're trying to do that. You almost have to suspend disbelief, right? And this is why focusing on the team and the big idea is super important in the early stages, because that's really all the evidence they have. So you have to decide as an angel where you want to invest. Now, I will say my experience in Seattle has been that many of the angels actually really want to invest in Series A, because that's how qualified they need the deal to be. But they actually, are writing check sizes in these sort of pre-seed rounds. And so you have this, hey, I want you to be profitable, and I want you to have 20 customers, and I want you to have all these sort of things, but I want these deal terms, and I'm only going to write a $5,000 check. And so these two things don't match. And so what ends up happening is you kind of both end up pissing each other off, and there's just a lot of angst and frustration with that. And so you can join syndicates, or Grub Stakes or Mercer Island Angels, and obviously Seattle Angel Conference, and all these different groups to make your check size bigger and to gravitate towards sort of the people in the groups that invest in the same areas that you would like to invest. So I think, that's kind of my table stakes, I guess, as I look at it for angel investors, and how you need to be prepared. Okay, so a couple of questions. How many of the 100 investments I've been making, that just moved, am I making evangelistic engagements in the last 6 months? So I would say I am active right now in probably 20 to 25% of my portfolio. And the reason why is there's some deals in some companies where the company is probably just too big. Like I can't provide as much value as I'd like to. I mean, I'm still there for the CEO and those sort of things. And I'm typically cheering for the sidelines, but I actually came up with like a quadrant for how I look at where I spend my time with my portfolio. And it all has to do with the size of the check and my relevant domain expertise. And as companies mature, oftentimes that gets reduced for me. So I think I add the most value in sort of the pre-seed to Series A, which is why that's where I write personal checks. And I use the VC funds to invest in sort of Series A to Series C. Because though I like those companies and it's a great education, I just personally can't provide value. Okay. Okay, so there's another question. If you do not invest today, is there a possibility you would want to invest 6 months down the line, provide some circumstances changed? So yeah, so I think, I mean, this is the interesting thing about not yet. And why I think it's important to add this to our vocabulary is to be not yet and tell people why you wouldn't invest. So a great example is a company called Tribute, which was part of which was actually one of our winners from Seattle Angel Conference 17. Sarah was also in SAC 16 and in SAC 15. And the crazy thing is, you know, she, I think she made it to like the final 10, maybe even higher in SAC 16. But her opening pitch for SAC 17 was, here were all the things that you told me I had to do when I didn't win SAC 16. And I checked off every single one of these boxes. And so I think the interesting thing is, you know, the team had given her very, very specific feedback on what she needed to go off and do and execute on. And she took that to heart, and she came back 6 months later saying, okay, here's all the things I've done. And she actually had a slide like that, which I just thought was a great way to sort of frame it. And it demonstrated a couple of things, not only her ability to execute, but the fact that she's coachable, that she heard people. And so, yes, absolutely, when you provide that not yet feedback, oftentimes founders capture that and execute on it. And I think that's a really important leadership quality. You know, the reality is people will just invest at different stages. And so, you know, in sales, they say the sale begins at no. I think, you know, in investing from an entrepreneur standpoint, the sale begins at not yet, right? Because now you know what objections you have to overcome and how you get there. John added a bunch of investment groups that you can see. There's a ton of groups, and there's a lot of overlap between the groups as well here in Seattle. Okay, John's listing out just a ton of stuff. Okay, so I'm going to move to the next slide. I apologize for bouncing in and bouncing out, but I want to be able to see the questions. Okay, so this is important because this is where entrepreneurs lose angels and investors. So I consider this table stakes. So if I'm if I was an entrepreneur, I would make sure before I go out and raise that I would have the following put together. So first is I'd put together a target list to start to identify my lead. So I'd go out and find out who's writing the big checks, or I'd go talk to all these different groups to understand what their process is and their timing and their check size and their terms and all that sort of stuff, so that I kind of knew what my audience was. And then once I've identified sort of who my lead is, or who I think is going to be my lead, right? So this is really important, is, you know, you need to make sure that when you're talking to these angel groups or these kind of super angels, people that are writing big checks, that you clearly understand what sort of companies they invest in. And you can go to Crunchbase and PitchBook and others to find out where they've previously invested and make sure you are a fit. This is the same thing you need to do with VCs. Don't waste anybody's time. Make sure you're a good fit, and then start to go have conversations and chase these people. You don't want to spend a ton of time chasing a bunch of small checks, because even if you got, say, 10 people investing $5,000 to $10,000 a piece, if you're trying to raise $500,000 to $1 million, you're still not very close. So spend your time going after the sort of big dogs, if you will, these super angels, and securing them. And at the same time you're having those conversations, just create a central location for all your docs. And your docs should be really, really basic, your legal structure. So just keep it simple, like C Corp, like don't make it tricky. Don't make it these LLCs. Don't make it like parent and subsidiary and I have IP overseas. Like that stuff will just spook investors. I mean, what you have to understand is you're competing for someone's time and someone's money. So the more friction, the more different you are at this stuff, like all of this should just be vanilla. But the more different you are, you just create friction. You just create an easy way for someone to say, I don't have time. This is really unusual. It spooks me. I'm out. So putting all this into, whether it's a Dropbox or DocSend or whatever it is, the legal structure, your cap table, we talked about the importance of keeping that clean. Have your pitch deck in there and make sure you're keeping that as up to date as possible. Your latest financials and projections. And depending on how early you are in the process, there may not be a lot, but there should be something. It's going to be hard to go out and ask someone to invest if you have even figured out what next year or the next couple of years looks like. And so my recommendation would be to have like a 3 to 5 year outlook with documented assumptions, and I'll come back to that in a little bit. But you got to have something in place. If you can't demonstrate that you are planning for growth, you're not going to get any investors. And then make sure you highlight your founding team. So there's a couple pieces here. So, you may not have a full team because you're early, and that's great, but identify what the key future hires looks like. So some of the best practices I've seen is that someone's actually written a job description and said, here's their background, here's the desired companies they come from, here's the skills we want to bring to the table, and here's what we think their compensation and equity is going to look like. You should have resumes for the existing team. And let's be clear, there shouldn't be anything cute. The resume should match LinkedIn. People should be on angel lists. Like, there should be a lot of easy ways for people, investors, to go and say, who in my network knows these people on this team? Because that's your whole goal here, is you want to remove and reduce the friction for your investors, make it silly simple. And then the last thing is you need to have a plan for an option pool. Doesn't matter what size of business you are, but when investors start to think about valuation and equity and all that sort of stuff, you need to at least have a sort of guiding principle or North Star on what you're thinking about with your option pool. Is that going to be 18%? What is that going to look like and why? And then the last thing in this whole table stakes process is, through the entire thing, you are building trust and you're building your brand reputation. So it isn't just a coffee meeting and those sort of things. Like, people are judging everything you do. The thing about this is like the ultimate job interview. You show up 15 minutes late, you take a call, you're looking at email, whatever it is, the investor is noticing, right? You're asking them to make an investment. And so you need to be focused, you need to be prepared, and you need to show up. So to me, these are like the table stakes that I see. Okay, John, I think answered the question on what a sidecar fund is. Do know that SAC does do sidecar funds. Oftentimes, if there's additional investment we want to make in companies, we do that. Okay, so John asked a question, what do I consider a clean cap table? So for me, a clean cap table is that basically I know the role or the function of everybody on the cap table. And that could be an advisor, an early stage investor, a founder, a key hire, those sort of things. When there's people on the cap table that I have no idea who they are or what they do, and they haven't interacted with the business for a significant period of time, like, that raises questions for me. And so, there are actually firms, there's one in the Valley, and all they do is, before people go out and raise, they clean up the cap table. They contact people on the cap table that shouldn't be there, and they negotiate purchases of their equity and everything else to sort of clean up the process. So you should identify the role, and so there's no surprises on the cap table, and explain how and why these people got there and what they do. So that's the clean cap table. Let's see. Okay, I love that the group's answering this, which is awesome. All right. So John asked a question, if I do equity in exchange for rent, is that a bad idea, right? Yeah, I mean, the reality is we've seen cap tables where founders have, say, not taken any salary and now converted that to equity, and either say, like, the company owes us this in the next round or next funding. All those things sort of just get silly. Again, you want the cap table to be clean and simple and well documented. And I guess the question is this: like, if you have to ask if it's clean or not, the chances are it's not clean. So that's the way to sort of think about it. Again, you're competing for investors' time and money in their investment, and this is not where you want to stand out and be different. You just want to be like everybody else in this process. Okay, so what I think investors focus on at this sort of pre-seed is is a couple things. So pre-seed is typically, let's call it like the first structured money. So I've exhausted friends and family, I've bootstrapped, I've done all that sort of stuff, and now I'm going to do some sort of formal thing. And it could be a safe, it could be a convertible note, it could be a priced round. Chances are it's a convertible note. The things that I could do due diligence on, because typically you're pretty early at this point, right, is I want to validate the total addressable market, or the TAM. And there's different ways to do this. There's TAM, there's what's called SAM, which is, so there's the total addressable market, there's an attainable market, and there's sort of different ways to triangulate with the product I have now, what can I go after? So a great one might be, I don't know, I'm going to go after B2B SaaS companies and I'm going to sell them advertising. So the TAM might be massive, right? We know Google and Facebook and Amazon are all playing in that space. But now as I start to drill in and I say, okay, what's my actual obtainable market with the MVP that I've built? It might be much smaller, but I can still tell a big story. And I can say, okay, this whole market is $100 billion. But right now with the product I have, here's what I think I can chisel away is we're going to focus on this one segment, which Jeffrey Moore calls a bowling pin. I'm going to focus on this one particular bowling pin, and that bowling pin is $5 billion. And as I start to build domain expertise and brand recognition, then I'm going to go after these other bowling pins. And I'll talk about that in a minute. But TAM is really important. So having a big target where you don't have to own 10% of the market, you can own a sub percent and still have a significant business is really, really important at this early stage. Now, remember, you're early. You don't have 10 paying customers or anything else. A big part of what you're selling is vision. And so you have to have this big opportunity, but you also have to have a strong, proven team. And so what's really important is of this strong, proven team is people have to have been doing this stuff together. Either you guys have known each other, guys and gals have known each other for a long period of time. You all went to school together, whatever it is. But this isn't like, hey, I had a great idea and I've never met these people before and we got together. Like, hopefully you've been at this for 18 to 24 months before you're really going out and looking at this pre-seed money. So you can actually point to strong record of delivery, collaborating, and working together and growing the business. The other big thing here is that all the key players should be on the cap table and should be dedicated. This is one of the areas where founders that are bootstrapping get really hung up is they do it as a side hustle. So there's been many deals that I've looked at where the CEO does this in the evenings and we all applaud them for like, this is great, but you're not going to stop doing this in the evenings just because I fund you. And if you is that what you're going to do? Is you're going to take that $500,000 that we've invested and now you're going to pay yourself a nice big salary? Like, you need to demonstrate this is 120% of your focus, and it is for all of your team, that they're motivated for the long-term vision, which is why they're on the cap table. And even if they're contractors, being able to show that, like, hey, when we want to hire them, and this is what this looks like, and this is why they're on the cap table. And the other big thing is just no surprises. I absolutely hate surprises, as does every other investor. All these things sort of just spook investors as you go through the process. So the focus here is, what can go right? And this is something that Jason Calacanis always says, is that early stage investors should not be looking for what's wrong and that, oh my gosh, Uber's in this segment or Amazon could launch a product that does this. You have to sort of suspend disbelief and say, okay, do I think this is a good team? And, chances are you're going to have to pivot and evolve and those sort of things. So do I have an intelligent, highly functional, collaborative team? And is the market big enough? And this is a big enough pain and a big enough problem. Typically, if those things are okay, and I have all of the other things like a clean cap table, blah, 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 and everybody's working on this 120%, like, yeah, that might be worth the price of entry to see how far this team can get and invest. And that mindset is not a Seattle mindset. That mindset is very much a Bay Area mindset that understand that the struggle is real and that failure rate is high, but they are betting on the team, not just the idea. Okay, we got a bunch of questions, so just give me a minute to kind of scroll through this. John pointed out from a cap table standpoint that a lawyer formed the company, has 60% of the company, that was one we passed on. There's just some crazy things that are certainly out there. Do you consider a founder's salary? So, yeah, I mean, part of it, what we look at is, and this is why having a plan is important, is when you raise, you're raising to last 18 to 24 months, right? So if you're raising $500,000 and everybody's getting big salaries, and that's not going to get you to 18 to 24 months, that's usually a red flag, right? Otherwise, you're basically doing a bridge round, and I don't know what you're bridging to. So I always look at them building out a forecast of expenses in addition to revenues and saying, okay, if I just look at the gross burn, how long is the gross burn going to go? Because what always seems to be happening is we're optimistic with our revenue projections and we're pessimistic with our expenses. And so that's why I always look at gross burn and figure out how many months the company has to live based on what they're asking us to invest. And so I think that's the hardest thing about being very early is in an ideal world, like you're not taking a salary, which means you're heavily relying on previous success, a spouse, or somebody else's income to kind of get you there, right? Which is why founders typically all live in a big house together or are running through incubators to try to cover their expenses. And the other thing on the salary is that founders cannot live on no salary forever. And so if your model says that we're going to live on no salary forever, that's not realistic. Eventually you'll start to see churn. And so there has to be this sort of comfortable median between what top wages are at, say, Amazon or Microsoft, and what the bare minimum is to live and survive and provide for yourself. So you need to be paying yourself something, and that needs to be modeled. That needs to be documented in the model. Yeah, I mean, John's got a point about sort of capital expenses and operational expenses. I mean, the reality is there's all sorts of free classes that you can take that tell you how a cap table works and how budgets and all those sort of things work. But as you go through this process, even if you don't have a lot of customers and you don't have a lot of revenue, you need to have command and control. You need to be demonstrating confidence that you know how to run a business, not just that you know how to build a product, but that you know how to run a business, manage cash flow, all those sort of things. Because believe it or not, that's sometimes what trips people up is that they run out of money, and they run out of money before they even know it, and then it's too late to do anything. So there's a question about how much non-dilutive grant funding affect investability, attractiveness to angels. So depending on the business, I think we've seen lots of companies in SAC where they've received government grants and those sort of things, and we just look at it as a great way to sort of extend the runway. Sometimes they truly are grants. Sometimes they're grants with an equity ownership standpoint. I think the devil's in the details, but typically what we see is that's just a way before you actually go out and raise. If you can get a grant and that can buy you an extra 6 months to progress on your milestones before you go raise a priced round, you should absolutely do that. So I think it's a problem when you try to do grants and priced rounds and all that sort of stuff together, that you sort of create angst. Okay, let's see. Yeah, so John brings up a good point. So let's be really clear. Everything is a frog in the startup world, right? There are no prince or princesses that show up and they're like, hey, I have this, $100 billion idea, and you get to invest and you're going to own 90% of it, and, nothing's broken. Like we all have our warts. Everything is imperfection. That's why making sure in the early stages you're betting on the team that can grind it out and overcome these issues is super important. So I just think that's the reality of investing. Yeah. So David added round expenses up, round revenue down is absolutely right. I think, the in sales, so everybody knows I'm a CRO, CMO, it's, set realistic expectations and overachieve those expectations. You will delight your investors if that is how you run your business. And if you build a model that way, you're going to be sure to have more cash than you need. So now as we kind of move from this sort of pre-seed to the seed, right? So we're in this middle stage, and this is where you're seeing sort of larger angels and seed funds play. The big things that they're focusing on is confirming product market fit. So, you had this thesis, right? And you're testing this thesis of here's my product, and I'm going to sell it to these people, and I'm going to sell it at this price point. Really, at the seed stage, like, we're confirming those assumptions hold true. And so there's a lot of focus on customer references, talking to the customers, not just about are they happy with the product and would they buy again and would they refer you? And all those things are important, but more of why did they make this decision? What other solutions did they look at? What were they doing before you came along? How were they solving this problem? Because what we're trying to do is validate a couple of things. One is the ideal customer profile, is that segment of targets big enough to get you to the valuation that you want to get to? Two is like, how do you find these people? How do you identify the pain? Because that's part of building a repeatable sort of sales and marketing and positioning process. And so talking to those customer references is super helpful, but they also use words and say things differently than you will. And so that will help us determine the things that you say that are important and valuable of your solution. Do they value as well, right? So, we've seen companies where they say they're selling X, the customer's buying them for Y. And, the real question is that Y product, is that where they should be focusing, or is that just a commodity business? And so digging into that at the customer references is super important. A technology assessment is important as well. Other than the fact that I invest in technology, I'm not a technologist. So, I always try to bring in an individual or a group of individuals to sort of comb through things and look at, what's the programming language? Are we using best practices? All those sort of things. Is there anything that might be of significant sort of IP, patentable, differentiated? And there's no right or wrong answer. It just sort of depends on the company. But I think that's really super important to understand what that looks like. I also do consider who's doing the coding and are there best practices, right? So I actually had one of my investments where the technical founder, got in a dispute, left, took the Amazon Web Services keys with him, and the company, which was doing nearly 10 million ARR, he basically held hostage. Now, part of this is because they hadn't, implemented best practices and sort of ensuring that, it wasn't tied to an individual, that it was tied to the company, but they had grown so fast, they hadn't implemented some of those things. So I try to, certainly now that's sort of top of mind for me. And so I'd like to try to mitigate some of those things. And that only really comes out as you go through some technical due diligence. There's this great idea of a leading predictor of churn. So I call it the leading predictor of churn metric. And so Slack is probably the most famous for this. And so Slack's metric of future customer retention is that when someone signs up for Slack, that they complete 5 actions within the first day, within a 24-hour period, which is why when you sign up for Slack and you join a Slack channel, the bot prompts you to do all these things. And they find that when people make that sort of investment in the product within that short period of time, that 80% of those customers are likely to return. And so I love it when founders start thinking about what is the definition of stickiness, right? We sometimes we call it active daily users, and everybody has their own metric, but you really need to think about usage, right? Just the initial adoption is one thing, but in the SaaS world, customers churn, and that's a lot of where I invest. But understanding what's that leading predictor of churn, so if they're not exhibiting this behavior, you're likely to lose them, to me is super important. And so just that founders are thinking about this, because at this point, maybe you have somewhere between 10 and 20 customers, but the fact that entrepreneurs are thinking about this demonstrates the fact that they're looking at this longevity. Otherwise, you're dealing with a leaky bucket situation, which is I might be signing up 5 new customers and losing 2 every quarter. And so I don't see the sort of growth metrics that I'm looking for. We talked a little bit about ICP, but I am a big fan of ideal customer profiles. I think you need to be able to clearly articulate the firmographic, demographic, and sort of tech stack that your customers need to have, so you know how to target them, and so that your pain points become repeatable and almost self-identifiable. And that's how you sort of shorten the sales process And quickly, going back to Jeffrey Moore, that's how before you cross the chasm, that's how you build passion and enthusiasm and excitement for whatever it is you're selling before you can sort of cross it. So this is like basically how are you reaching your sort of lunatic fringe and early adopters. Paying customers at this stage, you need to have paying customers. They need to be paying the ASP. Hopefully the vast majority of them are referenceable. They're committed to you. You know them all, especially as the CEO, and they're providing product input, and you're getting product feedback, and those sort of things is really, really important. And paying is not betas, it's not pilots, it's not trials. It's like you are really paying what it's worth. And then the next one is unit economics. So unit economics are basically all of the things that allow you to profitably scale your business. So it's understanding how many raw leads convert to marketing qualified leads, to sales qualified leads, to closed won deals. What's my customer retention rate? What's my customer acquisition rate? Lifetime value, like all of those sort of things that people are going to want to make sure you know, so that you can modify and pull on those cranks and levers to see the growth, right? Because when I'm funding you at seed, it's because I'm expecting in 18 to 24 months, you're going to raise a Series A, and chances are that Series A is going to be a 4 to 5 times valuation increase over what we're currently investing in at the seed stage. So I need to know that once I provide the gas, that you can hit the pedal and you are going to see tremendous scale of the business. And part of the way that you demonstrate that for me is not just understanding unit economics and how these things are captured and the costs and the drivers of that, but actually have a model with documented assumptions. So not just I'm going to sell to 10 customers and it's $15,000 a deal and all that sort of stuff, but sort of from the top of the funnel to the bottom. So I know what those conversion rates look like, churn metrics, what's my sales productivity. All those sort of things demonstrate that you have this command and control over your business. Because at this point, you've achieved product market fit, so you better have a really good understanding of what it takes to get to the next level. Okay, so I'm going to look at questions. Yeah, so Alex brings up a great point. Like, as you grow the business, the reality is we all have blind spots. There are always areas that we all have of weakness. And so this sort of better together, having a cohesive and collaborative team helps you address those. And that's really where, that co-founder model really works, right? So you want 2 or 3 or however many co-founders, but you want to make sure you have a solid team and you've addressed the other key hires you need to make in order to get you to the next level. So there's a question in here about how much do projected gross margins impact while raising funds. So depending on your business, you better understand your competitive benchmarks. You should understand sort of best in class, where you currently are, and what do you need to do to improve those margins. And in a lot of businesses, it's really about volume. And so, when you look at this sort of 3 to 5 year model, you can talk about where your current gross margins are and what are the levers that you need to pull in order to improve those margins over time. But what I find is what people are focused on right now is really a growth rate and can you get to profitability? And that's where unit economics become really, really important. It used to be growth at all costs, and now it's not. Now it's a trade-off where, okay, if you stop growing, could you at least maintain cash flow positive, break even? Especially, you're seeing it with what's happening now with COVID. Like the reality is the world is changing in very different ways and unpredictable ways. You may not be able to go raise more money. You don't necessarily want to have to do layoffs, but if you're hiring intelligently and on pace, you know when to hit pause and you know how that's going to impact your business. And so margins is important, but it's really understanding kind of when you get to that break-even point that I think is equally or more important. Okay, let's see. What is the key metric that indicates product market fit has been achieved by the company? I don't know that there's a particular metric. I guess the way that I look at it, and I geeked out and I wrote a blog post about ICP. And for me, that's one of the most important things. So for me, I look at a repeatable process. If I can line up all my customers and they can tell me that they bought for the same reason, they're using it for the same use case, and I can describe the environment and predict the next 2 or 3 customers, like then I start to feel like I have product market fit. And it's hard to do that without a significant amount of variability, which is why you as the leader, whether you're leading sales or not, need to have a relationship with your customers, because you're the one that really has to navigate this and figure this out. And then, once you have product market fit, when you add that next salesperson, so for me, like, because again, with my sales hat on, when you add that next salesperson, you know exactly the revenue impact that they're going to have on the business. So if my average rep is doing 10 deals, I know when I add this person and I have this ramp, that within 6 months, they will have closed, say, 6 deals. I'm like, okay, great. Now I know that I'm at product market fit and I can continue to add salespeople and achieve that same sort of goal. So that's the metric that I use for it. There's a lot of people that talk about sort of different metrics of success. The reality is you kind of know when you know, right? The velocity of the business starts to change significantly. There are certainly things on like user adoption. The challenges, and Alex brings up a point here about, a minimum of 100,000 users. It really depends on what your business model is. And that's why I think this leading indicator of churn is really important. And in fact, Rahul wrote a great blog post about it. He's the founder of Superhuman. Basically when you try to remove a functionality or take away the solution, if the customer says they can't live without it, you probably have achieved product market fit, right? And so it really depends on the segment you're in, and that's why targeting the right customers is super important. Okay, there's a lot of stuff in chat about that. Is an offshore development team seen as a negative? Generally reduces your cost, but there's So I mean, depending on how the agreement is with your offshore developer, it all comes down to IP. Right. So oftentimes what we see is when there's a strong technical co-founder that might be, say, like the CTO or chief architect, they might have all of the knowledge and they basically just outsource the development of it. That's typically okay as long as it's a reputable firm. Oftentimes what we see is they're offshoring it with the intention of when the company gets funding, that they go make an acquisition of those people, they would all become employees, and so the IP issues go away. I also think it just really depends. Just look at TikTok and all these other things. Depends where your offshore development center is, and how people might be fearful of that IP escaping and what might happen to it. And I think John's point is it really depends on how core the technology is being developed is to your valuation, whether or not it should be developed inside or outside the company. All right, awesome. I have another slide here just on the Series A. So now we've moved to, typically this is where I see it become like the first price round. So imagine this is where you're seeing all of your great lauded venture capitals. Pick your favorite one: Andreessen Horowitz, Madrona, whatever it is. Like this is where they start getting into these rounds. And so at this stage, really you've already demonstrated product market fit. You've demonstrated and have all sorts of documentation that you understand what your scale metrics are, and you're executing on those scale metrics, right? And so this is where you start to see. I'd say professionalism isn't the right word, but maybe a lot more structure around what that process looks like. The big one where I see people getting hung up on is that they're seeing like tremendous growth. So they'll talk about all the new logos in the new business, and they'll have at the top line this great growth of new business, but they have this leaky bucket. And basically what's happening is they don't have control of churn. And so they're losing customers. Now, sometimes it's because they pivoted, they've evolved, they've changed their pricing, those sort of things. But really understanding why your customers are churning is really important. So, as either a sales leader or the CEO of the business or both, it's really important to talk to your customers as they're leaving, just like it is when your employees exit, right? Think of it as like an exit interview and understand why they're leaving. Are they dissatisfied? Did you not deliver on a promise? Have you outgrown them? Have they outgrown you? Is there something else in the marketplace? All those sort of things, think of this as like a canary in the coal mine, right? You can get a lot of great intel from talking to these customers. And a lot of these customers, particularly if they're pissed, will be happy to tell senior leadership why they're leaving. But if you listen, you'll actually hear some great things in there, and it could be customer service related. It could be they're not seeing the ROI and the investment, and all those things you need to understand. And this is where I see a lot of Series A investors go, is they're so focused on your customer acquisition cost is high and your customers are churning, like eventually you're not going to be able to support this growth rate. Typically, they want to see 50 customers or more than 50 customers paying the average sales price. They want you to be able to show that you're increasing your ASP or expanding into these install-based customers. That the margins that you've talked about are being realized. So you have to be able to show margin improvement over that 3 to 5 year journey. That you have an eye on the next bowling pin, right? So going back to Jeffrey Moore and his bowling pin strategy, not only are you executing on your initial market, but you're looking to what's next, right? So you're like, okay, I've landed and expanded, and going back to the shoe example, I've made running shoes, and this is the next shoe I'm going to make. And they say, oh, okay, well, you've executed well here. We're going to fund you so you can go after this market, this secondary market, and continue to build on your first market. And then the other big thing here is you need to have a capital stack plan. So capital stack is basically a map that you put together of where you're going to get your subsequent rounds of funding. Some people call this a water flow diagram. What it's going to do to equity and ownership, dilution, liquidity preferences. And so there's a whole model that you need to put in there, but you also need to think about who are your funding partners. Now, since you guys are talking to Seattle Angel Conference, you're talking to angels, this is probably a little ways away, but this is a whole skill that you need to start thinking about, right? So every time you raise, typically people are going to want to get pro rata rights. So, when you're doing your pre-seed to your seed, even if it's a convertible note, you might have pro rata rights in there. They'll take up some portion, maybe 20 to 30% of your next round, and that kind of continues to move as you move through your funding cycle. But you want to make sure, let's just say in your Series A, that you take money from a VC that not only writes you a check for Series A, but is going to participate in Series B and has enough cash to do that, and that you're in their wheelhouse and that they do those things. There's a lot of specialty VCs that only say invest in seed rounds. And the problem is if that's what you fill your round with, now when it's time to go out for the next round, you don't have anybody you can draw on, right? You want to be able to leverage your investors for introductions into those next set of partners. They're going to make it easier for you to raise your round. And you want them to be champions and references and all those sort of things. So it's helpful if they can invest in the current and the next round. Any questions on that? Ooh, it doesn't look like John he put in a great blog post from both sides of the table. That blog is just a great blog to read on a variety of content. So, there's, like I said, there's a bunch of great stuff out there that you can certainly read that helps solve and address this issue. So that's all the slides that I have. I'm open to any questions, comments, feedback that you guys might have.
So, Kurt, one of the things that we see often is that people want checklists, and that the checklists somehow give them comfort. And I want to sort of spend a little bit of time focusing on this question of stage appropriate evaluation. And so if you're a company that's pre-revenue, you don't have a complete team, you're still in the hunt for product market fit, should you be raising angel funds?
Yeah, so I think you can, but I think this all comes down to qualifying your angels, right? So, it's like anything else. Like I think I made this mistake when I was out fundraising for my last company. Is, I was Sand Hill Road, and it's like, okay, there's 16 firms. I'm going to go see them all, and half of those were wasted meetings because people were like, yeah, I don't invest in this space, right? So just doing your basic homework and looking at like the last 3 investments and those sort of things will really tell you if these people will invest in your stage and age and the sort of segment that you're in. So that's one of the ways that you can sort of make sure you're talking to the right people. And I think the other thing is, as the entrepreneur, you have to be willing to sort of disqualify early and disqualify often, just like the angel is. Like if it isn't a fit and you're chasing somebody and they're being non-responsive or they're dragging you along, like your time is valuable. You have to run the business. And so you just have to be able to be willing to say, okay, I call them breakup letters, right? It's like, okay, this obviously isn't a great fit. Would love to continue the conversation. I'm going to add you to my quarterly updates. And oftentimes if you pull a deal from an angel, like you've set the hook. Now they're like, oh, wait a minute, like what's going on? Why don't they want me to participate? You see the same thing. Angels play the same games with entrepreneurs and say, okay, here's the terms I want. And the entrepreneur has to decide whether or not they want to participate in those. But I think, in this COVID situation, it's really, really hard. And so part of it is you're not just looking for people that write checks, but you're looking for evangelists and people that are going to help you network as well. And those are equally important.
Yeah, I would claim that they're more important. And I would say, at least at this early pre-seed stage, that the angel investment is sort of like a dowry, where it's enough money from the angel that it gets the angel's attention so that they do that evangelism for you. And if they're not writing a big enough check for them, that's an issue. But I want to get back to the, spray and pray angel process, right? We have 14 folks that presented at the AMA. And the classic answer from the entrepreneurs is, oh, look, 14 companies, I'm going after them all. And they did not qualify them. They did not think there was a sequence by which they could go after them strategically, that there are some groups that are simply not a fit at all. They shouldn't bother at all. There are other groups that are early and other groups that are late. And the ones that are early are going to do a different level of due diligence with different expectations than the ones that are late. And so the notion that I'm going to start at Madrona and I'm going to work down the angel stack until I get to yes, at least to me, is a great way to poison the well. That you should do it exactly the opposite way. Start at the bottom, work your way up, build your muscles, approach angel groups at the time that's appropriate for them, and maybe even approach angel groups so you find the champions in the angel group that leads you to the private individuals that will do what you need it to do because they care about what you care about, right?
Yeah.
So
I mean,
how do you expect people to, how do they actually do that?
So, I mean, part of being a founder is networking, right? And so I think, networking with companies that recently raised at your stage and even in your same space, and think of a broad space like hardware, software, med tech, whatever it is, like finding out who did they talk to, the conversations they had, what worked and what didn't work, I think is really, really important. I think the other thing is, like you look at like startup poker. I mean, there are a number of these things where there are birds of a feather where the founders get together and they can network and they can commiserate and those sort of things is helpful. But I'm not a fan of like going to LinkedIn and just blindly, because I receive 15 of these a day. It seems like now, of like someone just sending me a pitch deck. So take the time to see where did they invest. And if you can, you don't always know where they invested last, but a lot of that stuff is publicly available. And just do your homework. And I think that's an important thing. Like you can start with a question of, hey, this is the segment I'm in. I'm at this stage. Is this an area that you like to invest? And make it really easy for them to say yes or no. What I find is angels like to help. They just don't want to waste their time. And so, don't send them a pitch deck and continue to chase them down if they're not responsive. I think you have to make it easy for them to disqualify themselves or engage. And that's why I like DocSend. Like, I think, as a founder, putting in something basic of like, hey, here's who I am and everything else. I don't know if you invest in this space. Here's my deck if you want to take a look. they can immediately read the message and say, okay, I understand the space, you're pre-seed and you're in crypto. Like personally for me, that's not an area I invest in. I just disqualify. If I go to your deck, maybe I'm qualified. So then you can follow up a couple days later and say, hey, Kurt, I saw you checked out the deck. Like, did you have any questions? What do you think? Versus just blindly sending me another email a week later with the same freaking message and presentation.
Over and over again to a email address that's not even yours. How I know this,
Yeah.
yes. So the fundamental notion is, in this age of LinkedIn, where everybody who's semi-technical has a LinkedIn profile, it should not be that hard to get a warm introduction to an angel group. So why would you want to get cold decks?
Yeah, I mean, I think part of it is people just it's the hard work. There was a conversation we were having at one of the tables before this started, and I think part of it is like you have to approach everything with being prepared and having a plan, right? And so consider this your ideal investor profile or whatever. Like, what are the skills? What are the things that you want them to do? The check sizes, all that sort of stuff that give you a plan to get there. There's a number of there's angel lists and a number of other solutions where you can go and you can link your company profile and you can network with people. LinkedIn isn't always the best. There's lots of people that have angel or investor in their profile and they really aren't, or they haven't been for a very long time. And so that's not the best thing to do. Like, spend the time where active angels are and where they're looking at deals. And that's typically where I see the best approach. And I think the other thing is, we all want local investors, but the reality is, like, even people that used to just invest in the Valley are now on Zoom, right? Because you can't go from Palo Alto to San Francisco anymore, right? So you can get investors anywhere. So don't get hung up on they need to be from San Francisco. I mean, from Seattle or anywhere else. Like, find the best investors in your space and reach out to them. To get them interested. I think this is a really unique opportunity to get the best investors for your business versus just the local investors.
So the local geographic boundaries have evaporated with COVID. So if people are doing their work by Zoom, then away they go. Now, not all of the angel groups in Seattle have leaned into video, right? There are some that have pulled back and are only investing in their current companies to support their current investments, and they're not doing any due diligence remotely. But more than half of the people in the AMA said they were proactively investing over video. So we can go with that. So, there are 50 different places where you can put a company profile. You said Angel List. We use Gust at Seattle Angel Conference, but there's another several dozen places. Should I have a TechCrunch profile? Should I have a profile at PitchBook? Should I have a profile in Funders Club or Seed Invest or what?
Yeah, I mean, I think part of this is it just depends on the space that you're in and the sort of money you're looking for, right? Like, personally, I use Crunchbase and PitchBook and a few of the other ones, AngelList, because that's where I run my syndicate from and those sort of things. But I think you start out with 3 or 4 you think have the most sort of visibility, but you need to have a plan. It isn't just like show up and throw up. It's like, okay, now I'm there. What am I going to do? But I even think like basic things, like if you have advisors, get all of them to add that to your link to their LinkedIn profile. So people can be like, oh, like this person's associated with it. Like, invest in those connections because like anything else, people invest in people. It's all relationship driven. And, it's hard to find new people and convince them to invest just over Zoom. But if they know somebody that you worked with or they know another investor, all those things sort of grease the skids. And so that's just really helpful.
So in the Angel Conference, people apply and then we review their Gust profile and then we filter 100% based on the Gust profile, whether or not they're in the quarterfinals or not. So we care about Gust. All of the other angel groups but one care about Proseeder because they use Proseeder as their platform. So I posted Proseeder in the chat. The one that doesn't use Gust or Proseeder is E8, which uses spreadsheets. So those are the choices in Seattle anyway. So if you have a AngelList profile, a Gus profile, and a Proceeder profile, you've covered essentially Seattle. And that's probably true of Portland and British Columbia as well. Alex asked a question about the distance between Series A and your. Someone tells me Wendy says that E8 is using Proceeder. That's not what the guy said at the last Angel group. So that's good. I'm glad that they're using Proceeder. Alex asked something about seed round to Series A timing.
Yeah. So his question was, what's the shortest time between seed round and Series A that I've seen? Is there such a thing as too short a time period? Well, I mean, I guess the fastest time that I'd seen had been less than 12 months, but that was, I don't know, normal times, before now times. I don't know if those were normal times or not, but it was certainly in the last, I guess, 2.5 years. So I think a couple things happened. When you understand your unit economics, a small amount of funding can help you scale tremendously. And if you're playing in someone else's ecosystem, which is what happened to this company, that can just sort of create a tidal wave of opportunity. It's only too fast if it doesn't change the valuation significantly, right? So the interesting thing, and that's why I like to start to think about this capital stack and primarily dilution. And there are some really cool and free cap table tools that you can use out there. But understanding, and this is where I see founders get hosed all the time, is they never take in consideration liquidity preferences in their agreements, right? Liquidity preferences are like just absolutely horrible. But liquidity preferences are when a investor invests, let's just say their liquidity preference is 2x, then they put in $100,000. At the time that there's a company exit, they get their $100,000 out because that was their initial investment. And then there could be like a preference where it converts to common stock. But there's a number of different triggers that actually allow them to get a return greater than what a normal investor would invest at. And so understanding what that looks like and the valuation, that's the only reason why raising 2 rounds too close together could be a problem, right? If you're not creating tremendous growth and increase in your cap, then it isn't worth it. But you see lots of companies. I mean, Palantir is doing it now, right? Palantir is raising a $500,000 fund, and in September is going to IPO. And so clearly, what they're seeing is that I'm sure they're doing some cleanup on a number of different things, but they're doing this because they believe that in those. I mean, we're talking they even closed to $500 million. You're talking 6 to 8 weeks that they're going to more than 2x what their valuation is. So. Now obviously that's later stage. That's not seed to A. But I think if you can increase your valuation quickly, in a sizable fashion, time isn't an issue.
But if you can't increase your valuation, taking outside investment is crazy, and don't do it.
Well, yes and no. I mean, so it's about optionality. Like no one likes a down round, right? So I mean, yes, in the land of unicorns and rainbows, you would never take money quickly. But if let's just say you lose your biggest customer, or your competitor, or a massive company bought your competitor, and you're like, it's now or never. If your option is I could lose 80% of my business, by doing nothing, or I could lose 20% of my business by doing a down round, like maybe you do the down round, right? And that's a decision that you and the board would make. But there are always alternatives to venture capital. I mean, we always think that's great, but there's venture debt, which is not a bad word. And there's a number of things that you could do to help you get to where you need to get to. And it's all based on just situational awareness.
Right. So we're coming to the end of the question period and heading towards the mingle period. Are there any last questions people want to put into the channel? So for an example of revenue-based financing model, lighter capital is sort of the succeeding company that's doing SaaS investment with a debt instrument. It's well worth understanding how they do what they do. Any thoughts that people want to have before we mingle? Post it in the chat. So seeing none, we're going to break up to the chat. You can mingle by double clicking on the different tables and move around and visit people. We have some of our experienced investors are here. We have some new investors here. We have some of the companies that have applied here. And so please get a chance to meet everyone, and we'll go forward with that. If you have specific questions about Seattle Angel Conference this round, please seek me out or seek out Eric Watson, who is the LLC lead. So thanks very much. And Kurt, we're going to have these slides posted. So thank you so much for that.
You got it. Thanks for the opportunity, John. I'll see everybody in the mingle. Cool.